A sense of capital. Aloha, lads and gents. Welcome back to a new episode of A Sense of Capital Perspective Time. Actually, it's one of only a few episodes of Perspective Time. I will definitely change this in the future. So this is definitely a new type of video today, which I will publicate on a regular basis in the future, which is called Earnings Roundup. So I will always make a summary of the past earnings release results of the stocks I'm a shareholder of. And another new type of video will be a news format. This type of video I will launch each month on a regular basis. However, as always, before we jump right into the video, I just want to let you know, and that is very important because today is Judgment Day, but never forget, it's just judgment from my perspective. You are your own judge, you have your own opinion, your own research, your own due diligence process, and your own final evaluation and verdict. And guys, that's very, very important because today I will swing the hammer and make my personal decisions, but it is very likely that it's not the truth. And I'm just a human, I'm not perfect, I'm learning every day something new, and I like that this is the case. And I hope that you consider this at all the videos that you watch of me. Therefore, it will not be any financial advice, consultation whatsoever, and there is no guarantee for any correctness of the provided data. Okay guys, let's go. So what is this new type of content about? As you can see here, again, it's a summary. And why I'm doing this, if I already backed most of the earnings releases live through my stream, I think sometimes it's very important to just sleep a few nights on something, and sometimes you change your opinions or you adjust them slightly or you find something new, and I figure out that's for me by myself the case. And now that finally STONECO released their earnings results, I'm ready to start this new format, as mentioned already in the introduction of this video. And another aspect is definitely, as I mentioned already at the last Insights time period, after earnings season is before earnings season. Guys, I mean, it's like when you are in a bodybuilding contest, you know? I mean, as soon as you're done and you lift up your trophy, you need to prepare yourself for the next competition. And that's the same for us single stock investors. We should never sleep too much. We should always keep our eyes open and observe the environment and of course the stock itself. And this is what we're doing by, of course, taking a high focus on the earnings results. Before we jump in, I just want to let you know quickly that the structure of the design might be a little bit confusing. I will adjust it more and more in the future, the same like I did this in the past with my investment portfolio updates. It takes a little bit of time, but guys, be please a little bit patient. For this YouTube channel, it always counts the content and not just the look. Something else I want to mention is that I will not set too much focus now on the basic metrics I already discussed during the live streams. They will state it one more time on the sheets, but I will set definitely the focus on some more individual and specific highlights, which you sometimes need to understand if you read through different words and sentences of the reports, and which are as well a little bit interpreted by myself. Those highlights itself, the sources of them are not linked at the sheets, but you can find all of this information on the original investor relation pages of the different companies. And last but not least, I want to let you know that today I will just brief you about the content of the documentation which was uploaded. I will not consider any information which was communicated by the management during the earnings calls. I think actually it's a very, very interesting aspect, and I definitely want to catch up here in the future and want to make sure to cover this perspective as well, but not today. On the top part of the sheet you can already see the single stocks we were talking about today, the same you always see in Insights time periods. So ALFEN, GRAB, HIMS and HERS, New, PERION and STONECO. From my perspective, some very dynamic growth stocks, no matter if we talk about growth on the revenue or growth on the profit side. But before we start with the actual content, take a focus on the different individual stocks, I want to let you know one thing which is very crucial for me. So guys, there's a reason why I'm backing live the earnings results of the different companies I'm a shareholder of. I think it's a very crucial topic. It's not that easy always. It's not like going to a restaurant, order some food and you're done. It's more like you are in your own kitchen and need to make your food. It's even like you need to go before in the garden and make sure the vegetables are growing in the right direction and you can harvest them later on. Or it's like you have your own farm, you need to make sure that the chicken and the cows or whatsoever are growing well and are healthy and happy, of course. And that's the same here. Earnings releases, in my perspective, are definitely difficult content, but on the other hand, it's worth so much. You're so far ahead of all the other people out there who are not taking care of the earnings results, who just checking here and there the news, and they're thinking, oh yeah, I'm really up to date and I know everything about the stocks I'm a shareholder of. And guys, let's be honest, can you always mention all the stocks you are a shareholder of just based on your memory? Can you answer questions at all time, at any time, about different aspects of the company, different developments? What is the investment thesis? What is the strategy? What are the struggles? Way more important than the upside is the downside. What are the challenges the management, the company is confronted with? What is with the macroeconomical environment? All of this stuff is very, very important, and this is something what you get a really, really good feeling for when you are very close to the company and when you listen closely what the management is reporting to you by utilizing the earnings releases. And guys, to illustrate it a little bit more, for me it's like playing poker. It's like you have your cards in your hands and every new community card in the middle of the table is like news or like changes in the macroeconomical environment. Might be just noise or might be really adding value and changing something crucial. You never know. And then there is an aspect how the players at the poker table are acting, behaving, their face impressions, talking a lot or not, if they're making awkward sounds or not. These might be the rumors of the stock markets and of the overall economical market. And again, you can try to read something out of it or not. But what really counts at the end is when the players shows the cards which they're holding in their hands. That are the facts, and this is the situation when we talk about earnings results, when we talk about earnings releases. And that's the reason why I call this type of video crunch time, because then it really counts. And when you are on a level, and honestly I'm not perfect and I don't even know if I'm on that level, and very likely I'm not, but if you are on a level that you understand all the stuff what is happening during those results which get released, the documentation and the call, what the management is communicating, I think then you have really a good feeling and a good understanding about the stock you are a shareholder of. And if that's the case and you are still convinced about the stock you are holding, I think then you don't have any trouble facing positive, but way more important, more negative periods of the stock market. And I think that's the level of knowledge and wisdom we should try all together to achieve to be successful single stock investors. Okay guys, sorry for getting a little bit emotional and coming back to the actual content. So here we go. Just one information. Again, the sheets are a little bit unstructured. Please take your time and push the pause button if you like to analyze the sheets a little bit more in detail. Please reach out to me if you have any questions. I can completely understand if we don't share the opinions or if some uncertainties occur during watching this video. So starting with the first stock I'm a shareholder of, with ALFEN, the Dutch player and product provider of EV chargers, substations and battery systems. As you can see here, the date of release of this earnings results was mid of February, and overall the rating during the call was neutral. I didn't touch this, I left it and kept it on neutral even after sleeping on it a few nights. But let's take a look on the highlight on the lower part of the sheet, and as you can see here, negatively is for sure the adjusted EBITDA remains bad. When you compare the Q4 and Q3 results, you can see not changed too heavily, not rising and developing in a positive direction. Of course, compared to Q2, it looks a little bit better, but still compared to the EBITDA margin level of 2022 or 2021, there's definitely some room for improvement. I'm quite confident it will catch up again, I think, in the second half of the ongoing business year. What I think is a more neutral highlight in terms of what they reported is that the revenue outlook is, I think, sandbagged, honestly. They provided a range of 590 till 660 million euros in 2024, which is not bad, which is actually a year-on-year growth of 17 till 31%. But if you compare it to the CAGR, what they communicated through their own reports at the last earnings release, then you already can calculate and come to a result of a revenue just covering the market growth of 666 million euros, or a growth of 32%. So I think the revenue outlook is a little bit sandbagged and set up quite low, and I'm definitely ready for some positive surprise. But what is for sure very positive from my perspective is that the EV chargers finally recovered. I mean, it has a strong drop during the past months. The management defined 2023 as a gap year because primarily the EV charger product segment, and now from Q3 to Q4 2023 it recovered and grew by 10%, which is a very, very positive sign from my point of view. And the last highlight I want to mention in terms of ALFEN is the positive free cash flow target of 2024. I mean, they have one, yeah. So in the past 2 years, they always achieved a negative one, and to finally cover a positive one, I think investors will appreciate it and might create very positive attention and spotlight to this European very futuristic stock. The final fact on the top right, which is covered in gray color, is in this regard, will ALFEN really leave the gap year 2023 behind? That's for me the big question, the big doubt as well. We will figure it out together, but that's definitely the aspect which triggers me the most. Coming to the new stock, I'm a shareholder of Grab, the food delivery, mobility, financials and advertising service provider out of Southeast Asia. Guys, first earnings call, and if you took a look very closely during the stream, actually I was charging my car, and at the end of the video I was very heavily interrupted, so I need to move with my car. I mean, the other person was definitely right, no doubt about this, but that was the reason why I couldn't finalize my verdict. So during the call I was more on the yellow side, but now and afterwards I rated actually negative. And why that's the case, you can see already a little bit negative results on the metric side in terms of the outlook, but again I want to focus the highlights. And when I take a look at the highlights, you can see 3 positions, 3 bullet points which are marked and covered in red, and that's for me simply too much to give a stock a neutral rating. Starting with the first aspect, the gross merchandise value per monthly transactional user went down, and for me that's one of the key metrics, and I definitely can't accept that it's heading into the negative direction. It might be the case because they're offering now different delivery options, so you can go for a speed option which costs you more as a user, you can go for a neutral, a regular version and you pay a regular fee, and you can go for a slow version. And I think a lot of customers utilizing the slow version to save a little bit money, and as a result waiting a few more minutes for their delivery, for instance. So that might be a case why the GMV per MTU is lower. However, that's for sure something negative. Then another aspect, another key driver for me is the mobility incentives, which increased quite strongly. As you can see here, year on year, they grew by roughly 29 million US dollars. I'm not sure what's the reason. Might be the case that Grab is confronted with more competition in the mobility sector. However, definitely not something positive. I want to see that incentives get lower and lower year by year on a relative, but as well on absolute base. And in both perspectives, that was not the case in the past period. And last but not least, and for sure the most impactful aspect, I think as well for the most of you out there, is the revenue outlook. It's quite weak, 100 million US dollars less than most analysts expected. For me, it's not that difficult actually, and I can live with it, but it's always different, my perspective and the perspective of the market. And sometimes this kind of statements can crush a little bit the investor trust. And I am trusting still Grab, for me it's not creating any doubts, and I'm quite confident they sandbagging here, and the same like ALFEN, the second half of the ongoing business year will be a very successful one already because of the financial services. However, that's just the information we now need to work with. Which I rate neutral is that the fintech gets no in focus, which means that the management stated in the documentation that in the future, when they're reporting officially, it will be categorized as one of the 3 major pillars of Grab. So next to delivery and mobility, now the fintech, the financial services will get positioned, which is for me a big positive statement. Coming to the positive side, which is a little bit more comfortable to talk about for all of us, I guess. So again, here 3 bullet points, starting with the delivery GMV, which recovered. For me, as I mentioned during the live stream, GMV is more important than the actual revenue, just my perspective. And I like to see that the year-on-year growth increased quite heavily from 7% in Q3 to 13% in Q4 2023. The second aspect on the positive side is the fintech business Malaysia. It's a very heavy one in my perspective, and honestly guys, if that would not exist, I would be not an investor in Grab at all. That's just my opinion, my judgment at this point in time. And luckily, the fintech in Malaysia and as well in Singapore, but Malaysia I think is a little bit more successful, was quite a positive one. In the first 2 weeks after launch, they acquired 100,000 clients, which is quite impressive. And another aspect is here, what you can see on the bottom of the sheet. Maybe the super app is really working and synergies between the different services are honestly existing, and that's just really an amazing information. And why I'm thinking that's the case, I just checked this information and my brain is doing the rest actually. So they stated in their press release that 80% of the Malaysian fintech clients have been already customers to Grab other services, and that shows me really okay. They don't need to start from the scratch when they launch a new product or a new service. They can utilize the existing client base. Double thumbs up for this. Coming to the final fork, again colored in gray in the top right corner. And the question here is, what financial power can the fintech business create in the future? And guys, that's a big question, and I love that this big question exists. How boring the world would be if we already would know what will happen in the future. And I mean, so far it sounds very promising and I'm very confident for it. As soon as I see too many red flags, I will step immediately out of the stock and I will provide you an update on my social media channels, so make sure you follow them. But however, that's really an exciting aspect, and depending on your view on the company, a very crucial one. For me at least, it is definitely the most crucial one nowadays. Taking now the focus on HIMS and HERS, the third stock we will cover today. And guys, for me, that was definitely the highlight of the earnings season, no doubt about this. And yeah, if you like, you can share what was your highlight of your earnings season. But the digital doctor shop and pharmacy service and healthcare product provider out of the US just delivered. I mean, again, the eagle has landed. The metrics have been very positive, but you can see already here the marketing flywheel effect was marked in red. I was not very happy about this, and you can see it here as well when we take a look at the highlight section and the red position, because I wanted to state something negative as well. It is actually addressed to the same position, to the marketing flywheel effect. As you can see here, from my view, cross-selling is still not present, is still not taking place. It's still, for me, a very crucial aspect which we can't tickle, or which I can't at least tickle the box. And why I have this assumption, so basically, as you can see here, the revenue per subscriber is only slightly better Q on Q. And please don't forget, guys, we living in periods of inflation and prices increases, and just $2 Q on Q, I think is definitely no cross-selling when we talk about the average bucket per subscriber. The same you can observe on the marketing perspective. So here, marketing per subscriber, the marketing expenditure Q on Q rises actually by $1. So I would love to see it's getting lower and lower, because then acquiring more and more clients, and I at least hope they're spreading their marketing across more clients. But yes, very likely, and the management is acting correctly and making sure they achieving more and more market share and really try to cover as much of the cake as they can. But however, I would just simply love to see that they can achieve this target with lower expenditure level in terms of marketing, and finally they start cross-selling and sell someone who's a customer and originally might just ordered hair products as well as some skin products. We will see if that will be the case in the future, but for now, based on the numbers, I can't see it at least. Second position is a neutral one, and it's the payback period of less than 1 year. Actually, it could be a positive as well, because it's a quite positive information which makes you as an investor a little bit more relaxed, and you know, okay, 1 year is not 5 years. It's a predictable period of time. But however, it's very likely just something slightly under 1 year, and half a year would be better. So here I see as well some room for improvement. And now coming to the positive highlights, and actually we will talk about 5 different positions. Crazy, really crazy. If you are a shareholder of HIMS and HERS, enjoy the moment. It will very likely not always be the case. Not every stock is Nvidia and you run from one all-time high to another and personal best and whatsoever. So guys, starting with the adjusted EBITDA margin, which improved very, very strongly. You can see it here, Q on Q, by roughly 3%. Amazing. I mean, on the relative base, it's even more impressive, but already on the absolute base, 3%. Crazy. Very, very nice. Then going on with the telehealth and market share, that's something when other stocks would communicate this kind of development, it would be definitely the headline. Here's just one of the few, and that shows me at least how strong HIMS and HERS is delivering currently. And as you can see here, the development from 2022 to 2023, 14%, 22%, 35%, and now 49%. Almost 50% of the telehealth market, they have the shares in. Nothing to add here actually. Then going on, and it's getting even more crazy from my perspective, the subscriber adopting to the personalization. I mean, there was always huge doubt in the market from at least a few of the participants that they don't have any mode. And I think one of the key drivers to accomplish this kind of mode is the personalization, so that the medication they provide to their subscribers is personalized and they can't just purchase it from HIMS and HERS, and as soon as one of the competitors is providing it on a lower cost base, they're switching to another vendor of this medication. That's not possible with personalization. It really gives the trademark, the brand HIMS and HERS itself, a very individual taste, and I think that's really one of the success factors to achieve this mode. And I love to see that the customers adopting to it, and you can see in Q3 20% of the subscribers utilize personalized treatments, and 1 quarter later already 30% individualized and customized treatments. And now coming for me to the both highlights, even though the other aspects are already highlights from my perspective, but I think these are really highlights. First of all, and I need to highlight it here one more time, is the revenue outlook, which is simply outstanding. I mean, of course, EBITDA margin development not bad as well, but the revenue outlook, I mean, guys, as you can see here, Q3 2023, they stated a midterm guidance for 2025 of $1.2 billion. And 1 quarter later, they shifted this target to 1 year earlier, to already this business year, yeah, and stated an outlook revenue range of 1.17 till 1.2 billion US dollars. And guys, honestly, I think they're not considering, for instance, the weight loss segment at all. And I have the feeling they could even surprise the market and really provide the banger. That's just my personal opinion. So this outlook really digs strong momentum. And last but not least, very likely for most of you and for most of the analysts out there, the revenue outlook is very important. But for me, most important is the information that customer loyalty exists. As you can see here at the first red marked highlight, I mentioned cross-selling very likely is still not existing because of the revenue per subscriber and the marketing spend per subscriber. And yes, that's very likely the case. But what is as well the case is that they very likely just achieving more and more market share by investing into marketing and not to create some loyalty and reminding the customers to purchase again and again and again and being a loyal customer. I think these are really two very essential different parameters and perspectives. And you can check it out by yourself. They stated a chart where you can see how many repeaters are existing roughly and how many new customers existing per year from 2019 on. So since 3-4 years, roughly 50% of the customers are repeaters, and due to the aspect that each year they're having more and more customers and achieving a larger client base. I think nowadays they are at something like 1.2, 1.3 million customers in the US. That shows me that a huge amount of people loving their products and stay loyal to the brand and to the services. This is something for me which is really a game changer and which gives me the confidence that even though the marketing spend is increasing, it's invested in the right direction, achieving new customers, but still I think the existing customers stay loyal because of the products and not just because of the marketing spend. They kept it since a few years, and if they keep this momentum, maybe by the managing director stated number of 10 million subscribers in the future is not just a high-pitched number, a fairy tale. Maybe it becomes the truth. So halftime is done. Coming to the fourth stock I'm a shareholder of, which is new, the digital bank out of Brazil. As you can see here, they released their earnings results on 22nd of February, and I rated it during the earnings call as neutral, and I kept the neutral rating till today. I mean, coming down from an earnings result of HIMS and HERS, it's very difficult to compare. But guys, NU is simply delivering since quarters. It's crazy, and you can see it as well in the stock price. I can already come to the final fork right now. How long can they keep the momentum? And that's really the big question, because again, they're delivering. They keep it as it is, and I'm quite confident, and I hope at least they will stick to the strategy and can deliver as well in the future. However, not all highlights are positive. So starting with the red marked one, the negative one, the missed EPS target. And guys, it might be a minor one, but of course on the overall number of shares, it definitely makes an aspect that the earnings per share was lower than expected. For me, they still delivered very well, even on a margin perspective, but the end result, earnings per share, was not what they have originally targeted for. And this is something, of course, I don't want to ignore. Coming to the neutral aspect, the customer active rate remains solid. Actually, for me, it's almost a positive one, because it shows, yes, they're achieving a lot of new clients, but on the other hand, simultaneously, they're making sure that the relative client base is steady or even growing. You can see here, 1 year ago, 81.9% of the customers have been active customers, and now 1 year later, the number's even higher with 83.1%. So that's definitely a solid result. But now coming really to the straight positive ones, and for me, it's one which is HIMS and HERS still missing, and NU is actually achieving it already. It's the up and cross-selling aspect, which is, from my perspective, present. Why I rate it like this, as you can see here, the RPAC, which stands for average revenue per active customer. So exactly the customers we talked a minute about, they making more and more revenue with those customers. Started 1 year ago with $8.2 US, then $8.6 US, $9.3 US, $10 US, $10.6 US. Yes, of course, they're launching more and more services and products and creating a money platform, how they call it. And that's the case especially in newer markets, Mexico and Colombia. But however, that's very, very impressive from my point of view, and in combination with the next aspect, the cost to serve per customer, which is as well outstanding. That's a combination which makes sure that this company is heck of profitable. It's crazy, it's just amazing, incredible, outstanding, however you want to word it, very positive at the end. You can see here they have costs $0.9 US per customer and month, and that is 85 below the average compared to the traditional banks in the markets Brazil, Mexico and Colombia. That's simply crazy. I mean, that's really the potential of fintech, and that's the driver for new. And again, compare the RPARC development with the cost per served customer development or status. Crazy. It's a cash machine, and there is definitely a cause why the price is increasing that heavily in the past quarters and months. And there's definitely a cause why Warren Buffett stick to the new position he's a shareholder of, and on the other hand sold the Brazilian competitor, even if it's not the right wording, but other vendor of financial solutions as well, StoneCo, which we will talk later about. Coming to the stock, which is a little bit my stepson at the moment, PERION, the display and search advertising solutions vendor out of Israel. Guys, as I mentioned at the latest Insights Time episode, this stock provides me really headaches. I'm right in the research process, and what I can state already right now is the management simply is not providing a lot of information. The documentation is very compact, a low number of KPIs. I mean, if you have some time and you are interested how different kind of reporting documentation can look, please compare the StoneCo documentation, for instance, press release, with the press release of PERION. These are two different worlds. Just simply crazy. There is no investor letter if I'm not missing anything. So please keep in mind, I'm working with the information I have, and I am very sure that when you see now this sheet, you think, Julian, why you always suggest to make research about this company? It might be a good catch for all the people out there. And again, as I mentioned already in the Insights Time episode, I'm not that confident anymore, but that's the reason why I'm here. That's the reason why I'm doing research, and that's the reason why I'm always transparent to you and telling guys, do your own due diligence. It's your own money. That's really important. And as you can see here, I mean, really taking a focus on the results, it was pure red on the metrics perspective, more or less. Okay, revenue and profit was fine, but outlook very negative. All parameters which I observed negative. The overall verdict negative. And now you think, why you still are that highly interested in the stock? And guys, take a look at the final fact. It's getting even a little bit more awkward. I stated here, is the valuation too good to be true? And yet that's still the major question what I have in my mind. Am I just interested in the stock, in the company PERION, because it's crazy cheap and I think it's undervalued and I see something what others not see? Or am I missing something? And I think the upcoming stock analysis, which I will provide, will have a very high focus on this question. And it's a question which I can't answer, but I will try to get closer and closer to the answer at least. Based on the fundamentals, it is very, very cheap, but you get almost zero information. What is the base of those fundamentals? What is the products? What are services? How they really work? It's crazy difficult to get access to the information just from my perspective, just compared to the other stocks I'm a shareholder of. You're walking a little bit in the dark, and however, the numbers are very, very, very good. But on the other hand, honestly guys, I'm not 100% understanding the business. I'm not understanding 100% the numbers. And that is the point in time when my alarm bell in the back of my head is ringing a little bit, shaking, and makes me nervous. That's just the case. Okay, but now let's come to the highlights of the stock. Starting with the Performo Outlook 2024, which is very bad. What means Performo? So as I mentioned in the past at some insights time periods, they had a quite large acquisition with HiveStack. Great company from my perspective, very promising. However, of course, this stock or this acquisition will have the effect that the revenue get increased from this business year on, but as well the cost level. And so they have a performer and a non-performer outlook. And the performer outlook is basically the organic one without this unique acquisition event. And as you can see here, in 2023, they achieved a year-on-year revenue growth of 16%. And now on the organic level, they will achieve a year-on-year growth based on the guidance, based on the outlook of 10%, which is just bad from my perspective. And yes, they stated they will achieve 17% non-performer, so considering the acquisition of HiveStack, but of course we want to see that their legacy business, their traditional services and solutions are growing as well on an organic base. And I think that's not the case, and that's definitely not a good sign. Definitely not, for sure not. Really not good. And then we take a look on the adjusted EBITDA, and this is looking even worse. They're really tanking. I mean, 2023, even if it might be the case that it was a very positive year, they achieved 28% year-on-year growth, and now 1 year later they guided an outlook of 6% year-on-year. Oh man, guys, that makes me a little bit nervous. So let's go on, coming to the neutral perspective, to the yellow colored part. And as you can see here, they stated in the past business year, actually they guaranteed they will execute another acquisition of a company. And in their documentation, in their press release and in their presentation slide deck, they stated increase our investment in technology with our own R&D teams, including the new HiveStack teams, and through additional inorganic opportunities. So through additional inorganic opportunities, that is the aspect I want to underline in this context, which gives me high hopes when we talk about another acquisition. I mean, if they're not growing organic with the legacy business, then of course, at least I want to see they acquire new companies, develop them, and make sure that by doing this, the revenue growth is enhancing. Finalizing the evaluation of PERION with a positive aspect, the retail media and CTV. CTV stands for connected TV. Growth rises strongly. That's good. The retail media grew 196% year-on-year in the past quarter, and 1 quarter before just 112%, and you can see more or less the same development at CTV. So last quarter 69%, a quarter ago year-on-year they achieved 39%, so definitely that's a big plus. But I need to add one information here, and again that more or less has a bitter taste, is that they're doing display and search advertising, and display is separated primarily in video, retail and CTV. And currently a shift is going on from video to retail media and CTV. And so yes, that looks great that they're achieving high growth rates in retail media and CTV, but on the other hand, they're shifting this with purpose to achieve higher margins from video. So they're losing video share and losing video revenue and achieving retail media and achieving CTV revenue. So it's not the case that everything else is very solid and stable and CTV and retail is getting better and better. It's like they're selling ice, and now they tell their customers, guys, don't buy the vanilla ice anymore, buy the strawberry ice because it's cheaper or tastes better or something like this. I'm not sure if it's that positive. However, from my perspective, it's more positive than negative, and at least more positive compared to the other aspects I mentioned before. So again, this research process is a wild one. Guys, take care of yourself. Make sure before investing in the stock to really take time on it. The numbers look amazing, but what is going on behind the curtains, it's maybe another story, which doesn't mean that I don't want to be a shareholder. If I would like to change the status, I very likely would already have changed it. And I somehow trust the management, I trust the solutions, and I see reasons why they are communicating on a very low scale and things are like they are. But however, this is something what you need to keep in mind. And all the rest of the information, as already mentioned, in terms of the potential Microsoft search, advertising, extension deal, and other key aspects in the upcoming AAA plus stock analysis. Coming now to the end with the last stock we will talk about today, and the second stock which is located in the Brazilian market, which is STONECO, a point of sales terminal, ERP solution and fintech company. And guys, I can't deny, I like the company based on the numbers, but I really like the company itself. I like what they're doing for the community. I like the idea to provide access to financial power, not only on the B2C side, but as well on the B2B side. So for the different merchants, even smaller micro business merchants. But however, I rated it during the call neutral, so yellow, and I adjusted the rating later on to negative. And it was not because of just some informations which get communicated during the call or something like this, or which took place later on. It was just because really, the revenue achievement was not that great, and I marked it already red on the metrics perspective during the call. And the software division, I thought more and more about it, and I really don't like it. I don't like the aspect that it's developing so negatively and that the division itself is shrinking strongly. Honestly, I purchased originally STONECO because of the idea. They have these point of sales terminal solutions, where you put in your debit card, for instance, and pay what you purchased at the cash counter, but as well for the ERP solutions. I like to see them. I like these ERP solutions, how they work in gas stations, how they work in retail stores, how they work as warehouse software systems in pharmacies. Really, I like this. And this part of the business is just not working out at the moment. Take a look at the revenue growth. Q on Q. 1 year ago, they achieved a growth, even if it was not strong, but it was at least a positive growth of 2.8%. 1 year later, this quarter, Q4 2023, they achieved a negative growth. So basically, they shrinked by 6.4%. Wow, guys, really, I don't like this Q on Q growth. That is not that nice. So it's definitely a negative development. And taking a look at the adjusted EBITDA growth perspective, and keep in mind, I put it here in the brackets, it's X one-time restructuring costs. They invest some money in the software business, and I hope it's somehow supporting it in the future. But I deducted it even, and I'm very fair in this regard. But here, as you can see as well, Q4 2022 to Q3 2022, they grew by 11.3% in terms of the adjusted EBITDA. And now 1 year later, Q on Q, so Q3 to Q4 2023, they decreased by 11.6%. What is going on with the software division? I have no insights. They talked about synergies and potential comeback and restructured the management board and all this kind of stuff. Guys, I really hope it will be fruitful activities. But this is something what really makes an actual very, very positive, for me, a quite negative one. I need to be honest. The investment story is alive. No doubt about this. The point of sales terminal systems and the financial services are running so well. But the call itself was definitely negatively affected and rated just because more or less of the aspect of software. Even though it's just 50% of the revenue, it's just my opinion. I want to be strict here. And I don't like, that is the development we currently experience as shareholders of STONECO. However, let's go on and going a little bit more to the neutral side, and actually it's as well something negative, but it's on the other hand as well some positive. So from my perspective, they cracked a little bit the investor trust because the last two earnings releases have been very positive. So Q2 and Q3 2023. And I was hoping for STONECO that they achieved 3 times in a row very positive earnings results. But this history stopped by the latest numbers, and I could imagine that even other investors out there starting to get some doubts. So it can be positive because at least the history was positive. But now the development with the latest call was not that positive, so I colored it yellowish and I just want to state it, but for me it's not heavy negative, it's just my perspective. And now we come to the positive one, which is again always more positive to talk about, and that is the client base, which is rising very, very fast. So the MSMB payment clients, so micro, small and medium businesses, it's growing year on year by 47% in Q4. And on the fintech business side, so banking active clients, 200% year on year. Crazy. 37% MSMB payment clients and 200% banking active clients. Crazy. Keep in mind that MSMB is really worth a lot in my perspective because there are synergies existing between their point of sales and financial businesses, and the customers, the merchants who might be small now or even stated as micro businesses might be medium-sized or large-sized in the future. You never know, and maybe if the services of STONECO are good, they will stick to them and stay loyal. So that's a great number, and of course 200% banking active clients. Yeah, nothing to add, that's crazy. And then coming to the last position, which is even more crucial for me, the cash generation is just simply outstanding. I mean, it's an adjusted net cash position. Take a look by yourself if you want to see what this involves, but for me it's still a heavy statement. As you can see here, Q on Q in the last quarter they added 97 million US dollars to their bank account, and over the full year, when we leave out the shares buybacks which took place, they achieved 375 million US dollars on top. That's crazy. That's crazy from my perspective. That's almost 10% of the enterprise value. And be financially stable, making money. I mean, at the end, that counts. That is why people starting businesses and stocks getting traded publicly. Love to see this and give me a lot of confidence. However, I rated this call negative because, again, of the software division. But overall, the investment thesis is definitely alive. No question about it. But the final thought here again, top right, you see it colored in gray, is will there really be some software synergies in the future? Are they existing and can they dig it? I mean, they tried their best. They created some new strategies around it and told gas stations and retail stores are our core customers for synergies, and we try to really go for the cross-selling process over here. The future and of course the near future and mid-future, so I guess the next 4 till 8 quarters will prove if that's the case or not. I cross my fingers it is the case, but however I'm quite confident, even though it's not working out, the point of sales and the financial business is that strong that it will overshadow everything else in a positive manner. Here you can see the valuation table, which you are very likely already used to if you are a loyal viewer of my Insights Time episodes, and I just want to set the focus on the almost last column, the latest earnings column. As you can see, 3 times red, 3 times negative, 2 times neutral and 1 times positive. Was for sure not the most positive experience of my investment career this earnings season. I'm looking very confident to the next one and just cross my fingers getting better and better. Honestly guys, I'm counting more on Q3 and Q4. I don't think things will change too heavily in the next quarter, but as always I'm very interested and very excited, and I'm very happy that finally I could release my first earnings roundup, so you get a better feeling how I evaluate the stocks I'm a shareholder of and how the coloring of the latest earnings column here at this valuation sheets gets created. Guys, that's it for today. Thank you very much as always for watching. As you can see, the sun is still shining and blinding me and I'm still sweating. Whee! So I hope I can catch the last sun for today. Guys, what I'm now very curious about is which stock you are an owner of surprised you most in the positive and most in a negative way during the past earnings season. That would be very interesting, and of course why. Give me some information. I try to learn by myself. Maybe I hear something about stocks I never heard about, or some information I never heard about. So very excited what your thoughts are about the last earnings season. And of course, if you enjoyed the episode, please leave me a like and subscribe to the channel if you're happy with it, and be one of the first ones who supported me. That gives me always very positive momentum. And if you like to be updated about news, about facts of myself and the portfolio I own, make sure to follow me on Twitter, on Instagram and Reddit. You can find the links in my channel info underneath the video. And guys, last but not least, again, one more time, because I really gave so much information during this video and so much opinion. It's really just opinion. And there's no guarantee for correctness. Please go by yourself to the investor pages. Make sure you're doing your research. Make sure the numbers are 100% correctly. Make sure you go through this process by yourself. I really think that's so important. And guys, last but not least, keep in mind, after the earnings season is before the earnings season. So take care of your stocks, take care of yourself, and stay always healthy, and see you next time. Bye. A sense of capital.